Hello and welcome to the Business Interview. I'm Marcus Carlson. The European recovery is picking up pace. New figures from the European Commission this week suggest that growth in the Eurozone will be stronger than first thought on the back of a weak euro and low oil prices. But economists are hesitant to declare that the Eurozone is out of the woods, with the crisis in Greece still ongoing, for example. Two of the biggest Eurozone economies, France and Italy, are also underperforming the rest of the single currency area. To take us through the temperature and to take the temperature of the European recovery, we can turn to Patrick Artus, chief economist at the French bank Natixis. So welcome, first of all, to the programme. It's great to have you here. Now, the European Commission is expecting a growth rate of around about 1.5% this year, which is more optimistic than previously this year. Do you share the optimism here?
I think one should almost be more optimistic even than the Commission, because we are, as you mentioned, we have very exceptional circumstances, because the lower euro, lower oil prices, very low rates, and credit starts recovering. You see that in the data very clearly, and bank lending starts improving, including in France. Investment seems to be was already very, very rapidly improving in Spain. It starts to improve in Italy. We have the latest survey this morning in France, and we have a very, very good, very nice increase in the investment prospects for French corporates. So it might be the case that you go to very close to 2%, actually. So the question for me is not the next 2 years, except if an accident, of course, happens. Of course, can have a geopolitical crisis and oil prices start to increase again. But if you accept that, I mean, in the normal circumstances, I think you can be quite optimistic for the next 2 years. So the big issue is the medium term, what happens in 2017 and afterwards. But 2015 and 2016, things should be quite, well, it's not a boom in growth, but I think we should have a very decent growth during these 2 years.
The European Commission, though, is crediting the weaker euro, lower oil prices, a stimulus program launched by the European Central Bank, which is, of course, linked to the euro as well. What happens if you remove one of these legs?
That's a big issue of basically what economists call the exit from these policies. So basically, what's the most likely outcome for these policies in like 2 years or 1 year and a half? Oil prices might start recovering. Higher oil prices, of course, lower oil prices, today are increasing oil demand in the world. It's increasing gasoline demand very much in the US. Oil production in the US starts suffering because of these lower oil prices. So progressively, the oil market will rebalance. And then by the end of next year, we might end up with oil prices going back to like $80, $85. If this is the case, inflation in Europe will be closer to normal, to the ECB's target. Then the ECB will have indeed to get out of QE at the dates I've been announcing, which is in the fourth quarter of next year. Then if you have higher oil prices, which means a negative shock for demand, if the quantitative easing is over, then you've got higher rates, probably a stronger euro. So basically, what's left of this of today's boom in the economy in 2 years when all this stimulus has been taken out? And the answer lies very much in what will happen with corporate investment. So this is why corporate investment is a major issue currently in Europe. So again, we had some positive signs coming from Italy, some positive signs coming from France, but this has to be confirmed. Look, if it's like in the US, you've got a real recovery in corporate investment. Then, of course, this is promoting long-term growth. You've got more capacity, higher productivity, and then growth continues, even though the central bank has just just stopped QE. If you don't have that, then, of course, you take the big risk that growth starts just gets back to where it was before, and then you end up with very slow growth afterwards.
You mentioned France, you mentioned Italy there. If we look across the European map, though, those two countries are still underperforming. We're seeing growth powering ahead in Germany and Spain, particularly so in Ireland. Why is France and Italy lagging behind?
Italy, if you look at just the current state of the Italian economy, can be very, very concerned, because competitiveness has declined a lot. It's not improved since the crisis, which is very different from Spain or Ireland or Portugal or even Greece, because investment has collapsed. It's 30% below the pre-crisis level. productivity has been flat for 15 years. But apparently what Matteo Renzi has been doing on the labor market, the so-called Jobs Act, this labor reform, has changed the perception and the moral of Italian corporates very much. So we see.
But has it done more than change the narrative, so to speak?
No, I think
are these actual reforms?
No, well, economists were a bit skeptical because basically this is creating new labor contracts. This is introducing more security for the employers when they have to lay off. So it's going the right direction, but it's not the spectacular reform of the labor market. But still, the effects we seem to observe in the real economy in Italy seem to be very large. We see a very rapid improvement in investment expectations. We see a very rapid improvement on the labor market. Employment is really recovering very fast. So there's a big effect on confidence in Italy, which is very, very clear.
The story has been for the past year or so, or 2 years in the Eurozone, that France and Italy were the two sick men of Europe. If you then discount Italy, is France still the sick man of Europe alone?
Yeah, it's still the sick man. The medicine has to do some effect, at least on the Italian sick man. France, again, I think the real issue is the labor market. It's not linked to macroeconomic policies. We have an enormous problem in France, which is an incredible mismatch between the jobs which are being offered by the companies and the skills of the labor force. We've got 1.7 million vacant jobs in France, so jobs which just could be filled, but no one has the sufficient skills or education just to fill these jobs. So if you don't change that, if you see that's an enormous market between the skills which are demanded and the skills which are present in the population, then it's very hard to imagine that you've got a recovery in employment, in jobs, and a reduction in unemployment. So I think the real urgent thing to do in France is to reform the retraining system. The retraining system is an absolute disaster. Everyone knows it's extremely costly. It's not helping the people to go back to the labor market. It's very far from the needs of the corporates, of French corporates. So if you want to see an improvement in France, you need it's the most urgent thing to do well before the rest, is to change the retraining system and to make it much closer to the real needs of the economy.
Now, you've argued that this is kind of the new reality for France, with very low growth figures. What do you mean by that? Why do you think that France is now heading for an economy where growth will remain at these kind of levels where we are sitting at the moment, somewhere between 1% and 2%?
Well, it's not only France. We just finished a book on this. So it's very, very common. Every single country basically in the world is experiencing this very constant decline in productivity growth.
But are we looking at a technological revolution?
Yeah,
isn't that going to create growth?
This is the big mystery, and this is where you've got a very, very hot debate between historians, economists, whether these new technologies, the internet revolution, if you want, will be in the future changing, bringing a lot of technical progress, new goods, new processes, so big increase in productivity, or whether it's just a secondary, innovation. And historians distinguish between what they call process innovations. You're just improving the quality of the goods, you're improving the production processes. Basically, you buy your plane ticket on the internet, on your computer at home. So of course, it's much more efficient than just having to go to an Air France shop somewhere in the street.
But it's not going to bring about an industrial revolution.
At the end of the day, you go in a plane and it's the same service. You just travel in a plane, so it's just making it easier, but it's not radically changing the way you travel. Even in the US, IT jobs represent 3% of the jobs. So it's a very efficient part of the economy, but still very, very small. So far, we don't know what will be the situation in 20 years. But so far, internet or the digital economy or whatever is just again, it's a marginal improvement.
We mustn't be too confident, in
it's
other
a
words.
process. It's an innovation in terms of processes, but it's not radically changing the way we produce the goods. It's not creating really new services. We have to be patient, probably.
We're running out of program time, but I still want to ask you about Greece, because that's a major issue for the Eurozone economy at this stage. Greece is negotiating to get its hands on another bailout tranche from the Eurozone and the IMF. What are the risks associated to this now in your mind? There's been talk of a Grexit and the economic risks linked to that. Where do you think we are?
Well, three things here. I mean, A, no one knows, and we have to be, I think, extremely modest, what would happen if Greece was to leave the euro. Most of the observers and economists argue that it won't be a big shock, so there would be no contagion, that Greece is perceived as being a very specific case in the euro area. No one can be sure. It's clear that everyone would start thinking about the next possible exit. All the eyes would turn to Portugal, for instance. So I think no one wants to take the risk that Greece leaves. Even if the most probable outcome would be that there would be no big contagion to the others. But it's completely changing the nature of a monetary union. If a country can leave a monetary union, it's becoming more a fixed rate agreement. It's not so much a monetary union anymore. So I think the first thing is that no one wants to take the risk of a Grexit.
So as we're now looking at the talks then between Greece and its creditors, you're saying that there is common ground at the end of the day to form a basis for a deal.
At the end of the day, I think there will be a compromise. Now, there still are two risks. First risk involves the let's call that Troika, because, the Greeks don't want to use the name anymore, but let's still call that Troika.
Formerly known as the Troika.
So the Troika has to be aware that Greece won't have an access to the capital markets for many, many, many years. So whenever a part of the debt of Greece matures, it has to be refinanced by the Europeans or by the IMF. So Greece cannot go to the markets. So we have to be aware of that either the Greek defaults or we accept to refinance their debt when it matures. So there is no other choice. And so the way we proceed today, where every week we look at what has to be paid back the week after, and there starts to be a discussion whether the Greeks will pay back the IMF next Tuesday, and then the week after it's another repayments they have to do. This is creating only a lot of disturbances and a lot of instability on the economies of the market. So we have to take, I think the Commission has to accept the idea that they have to have a final way of treating this problem of the debt of Greece, which can only be a commitment to refinance as long as is necessary. If not, the Greeks will have only one choice, which is to default, and no one wants to have that. And the second thing is that it's very clear that when you speak to the Commission, no one trusts the Greeks.
Patrick Artus, I want to thank you very much indeed for taking the time to speak to us. We're going to be wrapping up this edition of the Business Interview. Thanks for watching.